Accounting is often called the language of business. This is because, much like any spoken language, accounting provides a structured way to communicate complex ideas and information. It translates the myriad of financial transactions and data into a coherent narrative that stakeholders can understand and act upon. Just as we use language to understand each other, businesses use accounting to understand their financial health. This understanding is crucial for making informed decisions, planning for the future, and ensuring the sustainability of the business. Without accounting, a business would be like a ship sailing without a compass, directionless, and prone to getting lost. Businesses use accounting to understand their financial health. This involves not just tracking income and expenses, but also analyzing trends, forecasting future performance, and identifying potential risks and opportunities. It's a comprehensive process that requires attention to detail and a deep understanding of financial principles. But like any language, accounting has its own rules and grammar. These rules, known as accounting principles and standards, ensure consistency and accuracy in financial reporting. They provide a common framework that accountants around the world can follow, making it easier to compare financial statements from different companies and industries. These rules help us make sense of the numbers and make informed decisions. By adhering to these principles, businesses can present a true and fair view of their financial position, which is essential for gaining the trust of investors, creditors, and other stakeholders. It's like having a set of guidelines that everyone agrees to follow, ensuring clarity and transparency. This is where accounting theory comes in. Accounting theory provides the underlying framework for understanding how accounting works. It delves into the concepts and assumptions that form the basis of accounting practices, helping us to understand why certain methods are used and how they impact financial reporting. It provides the framework for understanding how accounting works. This framework is essential for developing new accounting standards and practices, as it offers a foundation upon which to build. It also helps to resolve disputes and inconsistencies in financial reporting, ensuring that the information presented is reliable and relevant. Think of accounting theory as the laws of physics for the financial universe. Just as physics provides the principles that govern the natural world, accounting theory offers the principles that govern the financial world. It explains the relationships between different financial elements and how they interact with each other. Just as physics explains how planets move, accounting theory explains how financial information moves within a business. It helps us understand the flow of financial data, from the initial transaction to the final financial statement. This understanding is crucial for ensuring that financial information is accurate, complete, and useful for decision-making. It helps us understand the why behind the what of accounting. By exploring the reasons behind accounting practices, we can better appreciate their importance and apply them more effectively. This deeper understanding also enables us to adapt to changes in the business environment and develop innovative solutions to new challenges. Without a firm grasp of these principles, our financial decisions would be like launching a rocket without understanding gravity. Just as gravity is a fundamental force that affects everything in the physical world, accounting principles are fundamental to the financial world. They provide the stability and predictability needed to navigate the complexities of business finance, ensuring that our decisions are grounded in sound reasoning and accurate information. One of the most fundamental accounting theories is the element and structure accounting theory. This theory provides a framework for understanding the basic building blocks of accounting. It helps us identify, classify, and analyze the fundamental components of financial statements. Imagine the financial world as a vast cosmic dance. The element and structure accounting theory helps us identify the dancers and understand their movements. It tells us what elements make up financial statements such as assets, liabilities, and equity. It also explains how these elements are structured and relate to each other. The element and structure accounting theory rests on three key pillars: assets, liabilities, and equity. These pillars form the foundation upon which the entire structure of accounting is built. Without a clear understanding of these elements, it would be impossible to grasp the complexities of financial reporting and analysis. Each pillar plays a crucial role in the financial health and stability of a business, and together they provide a comprehensive picture of a company's financial position. Assets are what a company owns, like cash, equipment, or buildings. These are the resources that a business uses to generate revenue and sustain its operations. Assets can be tangible, such as machinery and real estate, or intangible, like patents and trademarks. They are essential for the day-to-day functioning of the company and are often categorized into current assets, which are expected to be converted into cash within a year, and non-current assets, which are long-term investments. Liabilities are what a company owes to others, such as loans or unpaid bills. These obligations represent the financial responsibilities that a business must fulfill. Liabilities can be short-term, like accounts payable and short-term loans, or long-term, such as mortgages and bonds payable. Managing liabilities effectively is crucial for maintaining the company's creditworthiness and financial stability. It involves careful planning and monitoring to ensure that the business can meet its obligations without compromising its operations. Equity represents the owner's stake in the company. It is the residual interest in the assets of the business after deducting liabilities. Equity can come from various sources, including the initial capital invested by the owners, retained earnings, and additional contributions from shareholders. It reflects the value that the owners have in the company and is a key indicator of the business's financial health. A higher equity value generally signifies a stronger financial position and greater potential for growth and expansion. These three elements are interconnected. The relationship between assets, liabilities, and equity is dynamic and constantly evolving. Changes in one element can have a significant impact on the others. For example, acquiring new assets may increase liabilities if financed through debt, or it may increase equity if funded by owner investments. Understanding these interconnections is essential for making informed financial decisions and for accurately assessing the company's financial performance. The accounting equation, assets equals liabilities plus equity, captures this relationship. This fundamental equation is the cornerstone of double-entry bookkeeping, ensuring that the balance sheet remains balanced. It provides a clear and concise way to represent the financial position of a business at any given point in time. By maintaining this balance, accountants can ensure the accuracy and integrity of financial records, which is critical for stakeholders who rely on this information for decision-making. This equation is the bedrock of accounting. It underpins all financial transactions and reporting, serving as a guiding principle for accountants. Every financial transaction affects at least two accounts, ensuring that the accounting equation remains in balance. This dual effect is what makes double-entry bookkeeping so reliable and effective. It provides a systematic approach to recording and analyzing financial data, which is essential for maintaining transparency and accountability in business operations. It shows that everything a company owns, assets, is either financed by borrowing, liabilities, or by owners' investments, equity. This financing structure is crucial for understanding how a business operates and grows. By analyzing the sources of financing, stakeholders can gain insights into the company's financial strategy and risk management practices. A balanced mix of liabilities and equity can provide the necessary resources for growth while maintaining financial stability. Understanding this relationship is crucial for interpreting financial statements. Financial statements provide a snapshot of a company's financial health, and the accounting equation is the key to unlocking this information. By analyzing the balance sheet, income statement, and cash flow statement, stakeholders can assess the company's performance, identify trends, and make informed decisions. Whether you are an investor, creditor, or manager, a solid grasp of the accounting equation and its components is essential for navigating the financial landscape. Section 4. Real-world orbits. Applying the theory. The element and structure accounting theory is not just an abstract concept. It has real-world applications that influence how businesses operate and make decisions. For example, when a company takes out a loan to purchase new equipment, this transaction impacts all three elements. The new equipment increases the company's assets. The loan increases the company's liabilities. The equity remains unchanged because the loan is used to finance the asset purchase. This simple example demonstrates how the element and structure accounting theory helps us track and understand the financial impact of business transactions. Section 5. The expanding universe of accounting knowledge. Understanding the element and structure accounting theory is like having a telescope to observe the financial universe. Just as a telescope allows us to see distant stars and galaxies, accounting theory helps us to see the intricate details of financial data that might otherwise be invisible. It opens up a world of information that is crucial for making sound financial decisions. It provides a framework for understanding the basic building blocks of accounting and how they interact. These building blocks include assets, liabilities, equity, revenues, and expenses. Each of these elements plays a vital role in the financial health of a business. By understanding how they fit together, we can gain insights into the overall financial picture of an organization. This knowledge is essential for anyone who wants to navigate the world of business and finance. In today's fast-paced and ever-changing financial landscape, having a solid grasp of accounting principles can be the difference between success and failure. Whether you're running a small business or managing a large corporation, understanding accounting theory can help you make better decisions and avoid costly mistakes. Whether you're an entrepreneur, an investor, or just someone who wants to manage their personal finances better, understanding this theory is crucial. Entrepreneurs need to understand their financial statements to make informed decisions about their business. Investors need to analyze financial data to make smart investment choices. Even individuals managing their personal finances can benefit from understanding basic accounting principles. It empowers you to make informed decisions based on a clear understanding of financial information. When you understand the elements and structure of accounting, you can interpret financial statements with confidence. This knowledge allows you to see beyond the numbers and understand the story they tell. It helps you to identify trends, spot potential problems, and seize opportunities. Just as astronomers use telescopes to explore the cosmos, we can use the element and structure accounting theory to explore and understand the financial world around us. By delving into the details of financial data, we can uncover insights that can drive better decision-making. This theory acts as our guide, helping us to navigate the complex and often confusing world of finance. It provides us with the tools we need to make sense of financial information and use it to our advantage. So, whether you're looking to grow your business, make smart investments, or simply manage your finances more effectively, understanding the expanding universe of accounting knowledge is key.